Hi, you're welcome to episode 3 of Making It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. On our previous episode, we looked at what accounting is. We're able to differentiate it from record keeping or bookkeeping, and then we were also to ascertain the various uses of accounting information. On this episode, we'll be looking at accounting standards, the various financial statements, and the various accounting principles or concepts underlying these financial statements. Let's go straight into it. So, one may ask, what are accounting standards and what is the need for them? So, accounting standards are various standards which guide or precepts or principles that guide the preparation of various financial statements. They go as far back as looking at the recognition, the measurement, the presentation, as well as disclosure of financial statements. But the question is, why the need for accounting standards? Accounting standards ensure one primary thing, which is a certain consistency in the preparation of financial statements, and also allows for comparability of financial statements of different organizations in different parts of the world. Let us say this. You have a situation where Company A prepares its financial statements. Company B also prepares its financial statements. So does Company C. Let's assume all of them are within the same industry. If there isn't a standard benchmark by which they are supposed to be preparing their financial statements, how will it be possible for the various users of financial information to compare the performance of these three organizations? Now let's look at even an extended situation where Company A is in, let's say, the mining industry. Company B is in the financial services industry. And then Company C is in the manufacturing industry. You can tell that the various peculiarities of those industries may lend itself to differences in how these various companies in these different industries would want to prepare and present their financial information. What accounting standards do for you and I, the users of financial information, is that it sets a standard to ensure that, notwithstanding the different industries of operation of these companies or businesses or organizations, you and I are able to take their financial statements and be able to make meaning across those different industries and compare their performance thereof. So you see, very important when it comes to accounting standards is the consistency in reporting that we'll find from various businesses, and that allows us, the users of financial information, to be able to compare the performance as well as the position and cash flows thereof of those various businesses, organizations, or institutions. So now we understand the need. Now the question is, who are those who set these accounting standards? So currently there is a body known as the International Accounting Standards Board. International Accounting Standards Board, known as the IASB, which is responsible for the setting of financial reporting standards when it comes to financial reporting across the globe. They have put together the financial reporting standards known as the International Financial Reporting Standards, simply known as the IFRS or the IFRSs. So these are standards which help us when it comes to the recognition, measurement, presentation, as well as disclosure of financial information within our financial statements across the globe. So remember this. The IASB, which is the International Accounting Standards Board, they put together or set out the IFRSs, which are the International Financial Reporting Standards, which we use for our financial reporting. And Ghana adopted the International Financial Reporting Standards in the year 2007. And when you look at the Companies Act of 2019, Act 992 of this Republic, you would find in section 127 of the Companies Act, that's section 1275, indicating that financial statements shall be prepared in accordance with the International Financial Reporting Standards or any such standards as may be laid out or set out by the Institute of Chartered Accountants, Ghana. That introduces something. That tells you that when it comes to Ghana, the reporting of financial information is a process or an activity which has the oversight of the Institute of Chartered Accountants, Ghana. We call them the ICAG. So remember this. The International Accounting Standards Board, they set out the International Financial Reporting Standards. When it comes to Ghana, this has been codified in statute, which is Act 992, the Companies Act of 2019, in section 1275. And it stipulates that all financial statements shall be prepared in accordance with the International Financial Reporting Standards or any such standards or principles of accounting as may be prescribed or set out by the Institute of Chartered Accountants, Ghana. So, per the IFRSs, or the International Financial Reporting Standards, what are the various statements that need to be prepared? Once again, when you go to section 1275A of the Companies Act, that's of 2019, Act 992, it stipulates 5 different elements of the financial statements. 1, the statement of financial position. 2, the statement of comprehensive income. 3, the statement of changes in equity. 4, the statement of cash flows. And then 5, and this is very important, the various notes to the financial statements which present further information to the various financial statements aforementioned. And so, as you can tell, there are 5 necessary elements that should go into any set of financial statements. The statement of financial position, the statement of comprehensive income, the statement of changes in equity, the statement of cash flows, and then the various explanatory notes that provide further disclosure to the various statements that have been aforementioned. I hope this is clear up to this point. Good. Now, let's look at these various statements as have been aforementioned. Let's look at the statement of financial position. So what the statement of financial position does is it records the assets, liabilities, and the capital of the shareholders and present it as of a point in time. What is the essence of that? This statement gives a snapshot of the position of the company. So it shows in a snapshot its assets, its liabilities, and also the shareholders' account or the owner's equity when it comes to the company. So it gives a snapshot of the company or of the business at a point in time. That's the first thing. Now, let's look at the statement of comprehensive income. So what the statement of comprehensive income does is to demonstrate the performance of the company for a certain period. And so typically, you'd find that the heading of a statement of comprehensive income would read, Statement of Comprehensive Income of Company ABC for the period ended December 2025, or for the year ended December 2025. So as you can tell, the statement of comprehensive income talks about the performance of the business for a certain period. It will typically lay out the incomes and the expenses of the business to net off and show the profit of the organization. And so I take that again. It will lay out the incomes and the expenses of the organization during that period, and the net off of those two is going to be showing the profit or loss for that period for which the reporting is being done. So outright, one of the things you would see by way of a difference between the statement of financial position and the statement of comprehensive income is that whereas the statement of financial position speaks to the position at a point in time of the business, the statement of comprehensive income speaks to the performance of the business over a certain period of time. So whereas the statement of financial position is of a point, the statement of changes in comprehensive income, or statement of comprehensive income I should say, speaks to the flow of the business over a period of time. I hope this makes sense. Good. Now, the third statement, the statement of changes in equity. So the statement of changes in equity, it shows what would typically be called the net assets of the company. And what it basically means is when you take out the liabilities of the company from its assets, the difference is what we call the net assets. And these net assets that we talk about, it is the same as what will be inuring to the owners of the business. And so the owners of the business are those we call the shareholders or the equity holders or the owners. And so everything as far as benefits to them is what we are calling the shareholders' equity or the net assets of the business. And so that is what the statement of changes in equity does. In fact, by way of comparison to the statement of financial position, the statement of changes in equity is actually a component, an extract, a carve out from the statement of financial position. So whereas the statement of financial position will show the assets, the liabilities, and the capital or equity component, the statement of changes in equity will show only the equity component, but then breaks it further into detail to see how it started and how it has changed over the reporting period and what the position is at the end of that period. And that's why it's called the statement of changes in equity. I hope that makes sense and that's understandable. Good. Now, let's look at the fourth statement, which is the statement of cash flows. The statement of cash flows. The statement of cash flows basically speaks to the movement of cash when it comes to operating activities of the business, investing activities of the business, as well as the financing activities of the business. And so you can tell that this is also a flow report, or a report which demonstrates flow. So the question would then be, why is this statement important if we have the statement of comprehensive income? That would be a very good question. This is why. Whereas the statement of comprehensive income reports incomes and expenses as they are earned or accrued, the statement of cash flows record actual movements in cash. Actual movements in cash. I will explain that. When it comes to a business selling a number of goods, when it sells goods for, let's say, 1,000 Ghana cedis, and the customer is yet to pay for those goods, the company will still record revenue as having made a sale to the tune of 1,000 Ghana cedis. In the same way, if the company goes to buy goods or procures services to the tune of 2,000 Ghana cedis, even when the company has not yet made payments for those goods, so long as they have received it, they will record an expense to the tune of the 2,000 Ghana cedis in the statement of comprehensive income. So you'd realize that these two transactions, although there has not been movement in cash, have been reported and will be used in the assessment of what profit is. So you see here, money has not moved, but we have reported revenue, we've reported expense, and we know the profits thereof. What the statement of cash flows would do for us is to report actual movements in cash, so that for the business, it can tell at the beginning of the reporting period what its cash and cash equivalent balances were, what the various flows of cash as far as its operations, its investment decisions, as well as its financing decisions were concerned, and what its cash balances are at the end of the reporting period. So you see the difference. Although both of them are flow concepts, one has got to do with earnings being actually made or expenses being accrued, whereas another has got to do with actual movements when it comes to cash. I hope that makes sense. Great. Now, the final one, the notes or explanatory notes to the various financial statements are four explained, which are the four that we've spoken about. So you see, when you present these statements, statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows, these are primarily numbers with a few descriptions to them, but there are further details or stories behind them which would enable any user of those financial statements to get better understanding of these statements. And that's why they become very important, and that's why we call them explanatory notes. And so that would also be required for the various numbers or descriptions that are put on the faces of the financial statements. So now we have clarity on what the set of financial statements are. Good. Now we would want to go to the accounting concepts which underlie the preparation of these financial statements. So for these various statements that have to be prepared in accordance with the International Financial Reporting Standards, they are underpinned by certain principles or concepts of accounting, which we call accounting concepts, as simple as that, or accounting principles. These we'll be discussing in the next episode. But as we wrap up this episode, let's just do a quick recap of what we have looked at in this episode. We were able to look at what accounting standards are, and we learned that these are the various principles, policies, estimates, all of those that guide the preparation of financial statements or the treatment of financial transactions. And they've got to do with the recognition, the measurement, the presentation, as well as further disclosures that are provided for accounting transactions and even financial statements. We were also able to establish the need for accounting standards because they bring in the consistency in the preparation of financial statements, which allow comparability of the various financial statements of different entities in different places or jurisdictions. Then we sought to understand who are those responsible for setting out these accounting standards, and we learned that it is the International Accounting Standards Board, and they set out the financial reporting standards that we know as the International Financial Reporting Standards, IFRS, and that Ghana adopted the IFRSs in the year 2007, and it is codified in the Companies Act of 2019, Act 992, specifically Section 1275, where it is mentioned that financial statements shall be prepared in accordance with the International Financial Reporting Standards, which have been adopted by the Institute of Chartered Accountants, Ghana, or any other financial reporting standards as shall be adopted by the Institute. And we learned that there are 5 elements of the financial statement as according to the International Financial Reporting Standards. The first being the statement of financial position, the statement of comprehensive income, the statement of cash flows, the statement of changes in equity, and also the various significant accounting policies and estimates, as well as explanatory notes to the financial statements aforementioned. I hope this has brought some good clarity to accounting standards and financial statements. Good. So we'll be looking at the next element, which is the various accounting principles or concepts which underlie these financial statement preparation in the next episode. My name is Benjamin Ofeado, and let's meet on the next one.